Hello everyone, silver possibly getting shoved into another major squeeze because of a change most people would normally ignore. So, in this video, we're going to separate what actually matters from what is just noise, and you are going to walk away a whole lot smarter and a whole lot calmer about what may be building in this market. And in New York, it is Wednesday, April 15th. Go ahead and tell me in the comments what day and date you're watching from. And real quick, if you value these breakdowns, support the channel by subscribing and comment John A.G. Best, so I know you want more of this kind of work. Because here's the thing, the second silver gets one dramatic headline, people start acting like the whole market is about to detonate by breakfast. That's not how I look at it. I'm bullish, yes. I think this setup is serious, yes. But lazy excitement is not analysis, and if you let every loud headline push you around, this market will embarrass you. What matters right now is not fantasy. What matters is that silver was already sitting in a delicate position, and then a fresh supply chain complication showed up at exactly the wrong time. That complication is sulfuric acid. Now I know that doesn't sound exciting. It sounds like something you slept through in school. But boring inputs can become very important when they touch the right part of the production chain. China is expected to halt sulfuric acid exports beginning in May, and that matters because sulfuric acid is heavily tied to copper processing. Silver, of course, is not produced only from primary silver mines. A large share comes as a byproduct from other mining activity, especially base metals, and that means pressure on copper economics can spill over into silver supply as well. Now let me slow that down because this is where people either get sharper or they get manipulated. If copper smelters and related operators lose an important byproduct cushion, if processing margins get uglier, or if maintenance and output decisions start shifting because profitability is being squeezed, then copper production can get trimmed around the edges. And if copper production gets trimmed, byproduct silver can feel it too. Not in some movie scene way, in a very boring, mechanical, real-world way. Recent reporting indicates that some Chinese copper smelters may move ahead with production curbs or bring maintenance forward after the acid export halt, especially since treatment charges are already deeply pressured. That is why this story matters. But here's the part I want to keep honest. One change does not guarantee an instant moonshot in silver. Markets adapt, material gets rerouted, inventories get stretched. Some operations can absorb the pain better than others. So if somebody tells you this headline alone guarantees a straight vertical move, I think that is too simplistic. What I do think is this. A market that is already tight does not need a giant shock. Sometimes it only needs one more push. And silver has already been living in that kind of world for a while now. Based on recently published industry numbers, the global silver market is projected to run a sixth straight annual deficit this year. The shortfall is expected to widen from last year, and the market has been leaning on inventory drawdowns for several years now. Since the early part of this decade, hundreds of millions of ounces have been pulled from stocks. That does not mean the world is out of silver. It means the market has been relying on stored metal for longer than many people realized. That distinction matters a lot, because a market can look fine on the surface while getting more fragile underneath. It can look liquid until somebody suddenly needs metal now instead of later. It can look calm until financing, shipping, sentiment, and physical demand all lean the same way at once. We already got a glimpse of that. London silver tightness became a real issue not long ago. Some of that pressure eased after metal moved in from other regions, and a larger share of London stocks is now outside exchange-traded holdings than during the worst of the squeeze. That has helped liquidity. But improved is not the same as healed. Better is not the same as comfortable. The same research warning of another deficit this year also says another squeeze remains possible if volatility rises again, or demand from key buyers picks back up. That's the setup people need to understand. Silver had already put in a monster move, then got hit hard, then tried to stabilize. Gold also pulled back from extreme highs, but the bigger precious metals picture never really died. It just became less easy. And a lot of investors confuse a harder environment with a broken thesis. No. Sometimes price cools off because leverage gets flushed out. Sometimes it cools off because people chase too late. Sometimes it cools off because a hot market needs to breathe. That is not automatically the same as the long-term case falling apart. And the long-term case here is bigger than this acid story. Silver still sits at the crossroads of two powerful narratives. One is monetary. It benefits when faith in policy, debt, deficits, and fiat management starts getting shaky. The other is industrial. It stays plugged into electronics, electrical systems, autos, data infrastructure, defense applications, and energy equipment. Those two worlds do not always pull at the same time, but when they start overlapping, silver can move with an attitude very few assets can match. Now, to stay balanced, not every industrial story is a straight line higher. Some manufacturers keep trying to thrift. Some demand sectors cool off when growth slows, The latest silver market outlook actually points to softer industrial use this year than last year because the broader economy has taken hits. So I am not going to sit here and tell you every part of demand is roaring at full speed all at once. It isn't. But the interesting part is that the market can still remain in deficit even with weaker industrial use because supply is not exactly bursting higher either, while coin and bar investment is expected to rebound strongly. That should get your attention. It means the market does not need perfection to stay tight. And let's talk about gold for a second, because gold leaves footprints all over the silver story, whether people admit it or not. Total gold demand last year, including over-the-counter activity, pushed above 5,000 tons for the first time ever. Investment flows were strong. Bar and coin buying hit the highest level in more than a decade. And exchange-traded fund holdings had one of their strongest years on record. At the same time, central banks kept buying. Net official sector demand stayed durable through the year, with a strong finish in the final quarter. That is not some tiny side note. That is a signal. It says record prices did not scare everybody away. It says reserve diversification is still a live issue. It says confidence in the existing monetary order is not exactly perfect. And when gold stays elevated for those reasons, silver eventually gets dragged back into the conversation. Sometimes slowly, then very, very quickly. And there is another fresh layer here that I think people are underestimating. The professional forecast crowd came into this year already expecting precious metals to stay volatile and push into new highs, with some analysts looking for silver to trade far above last year's average and even test levels that would have sounded absurd not long ago. That does not mean every forecast comes true. Most forecasts don't, at least not on schedule. But it does tell you that the conversation around silver has changed. This is no longer a sleepy side market in the eyes of people who watch Bullion full-time. Survey commentary this year has openly tied silver's upside case to London tightness and unusual futures market structure, which tells you the stress points are visible well beyond social media chatter. And one more thing, free float matters a lot. Research this week noted that the share of London silver stocks not tied up in exchange-traded products improved from last autumn's extreme tightness, which is good, but it is still the kind of metric serious traders are watching because it speaks to how much metal is really available to grease the system when demand turns urgent. People love talking about total inventories as if every ounce is equally available at the same moment. It isn't. Some metal is sticky, some is spoken for, some is simply not moving unless price changes behavior. That is why a market can look numerically supplied and still feel functionally tense. And when a market stays this sensitive, even modest changes in flows, hedging, or physical buying can hit harder than outsiders usually expect, because silver does not have the depth of bigger markets. From recent market commentary, even mainstream futures market outlook pieces entering this year were highlighting silver deficits, ongoing physical tightness, and the likelihood that central bank demand would remain an important structural driver for gold. In other words, this is not just a fringe internet story anymore. Parts of the formal market structure are openly acknowledging that the fundamentals underneath precious metals are still stronger than many people expected. Now layer the acid story on top of that. Add in the fact that the Democratic Republic of Congo, one of the world's critical copper and cobalt regions, has already been dealing with disrupted supply of key leaching chemicals because of shipping problems tied to the regional conflict. Recent reporting says miners there have reduced chemical use and face delays stretching from weeks into months. So this is not only a China headline, it is part of a broader reminder that mining supply chains are more vulnerable than they look when everything is flowing smoothly. That's why I keep saying the issue is not one headline by itself. The issue is one more pressure point showing up in a market that was never as relaxed as people wanted to believe. And if you're successful, share your success story in the comments so others can stay motivated. Because this market rewards people who can stay steady while everybody else swings from euphoria to despair and back again. Now, I want to challenge one more idea. There are people out there acting like every sign of tightness means the paper market is finished, the physical market has won, and every ounce is about to be repriced into another universe. I'm skeptical of that kind of all-or-nothing thinking. Tightness can be very real without meaning the whole system collapses tomorrow. Elevated lease rates, unusual spreads, stressed logistics, or nearby premiums can all be serious without automatically meaning total failure. In fact, some of the best bull markets climb through periods of adjustment rather than catastrophe. That matters, because if your thesis depends on the entire market breaking overnight, then you are rooting for chaos instead of understanding repricing. I don't think silver needs chaos to go higher. I think it needs continued deficits, periodic volatility, renewed investment demand, and just enough macro distrust to keep pulling attention back toward hard assets. That is a much more realistic path, and honestly, it is a healthier one. Now zoom out even more. If people keep worrying about sovereign debt, fiscal slippage, currency debasement, and political pressure on institutions, they do not all run to the same place immediately. Some go to cash, some go to equities, some go to digital assets, some go to land. But a slice of that concern almost always finds its way into gold first, and then silver starts getting rediscovered right after that. That process is familiar, and once the public starts feeling squeezed in daily life, behavior changes. Not because everybody becomes a metals expert overnight, but because pain sharpens attention. People ask harder questions when costs stay high, confidence gets thinner, and financial promises start sounding less comforting. That is when ownership starts to matter. Not just owning the right thing, but owning it for the right reason. If you only own silver because you think one dramatic headline will make you rich next week, you are probably going to get shaken out. But if you own it because you understand that it is a small market, structurally sensitive, emotionally ignored until it suddenly is not, and increasingly tied to both industrial necessity and monetary unease, then you can sit through the noise with a lot more discipline. So where do I land? I think the sulfuric acid development is real. I think it matters. I think it strengthens an existing bullish case rather than creating one out of thin air. I also think some people are getting way too dramatic, way too fast, and confusing a serious setup with a guaranteed immediate payoff. Those are not the same thing. Silver does not need a fairy tale to stay bullish. It already has enough going for it. Recurring deficits, inventory reliance, a small market size, lingering physical tightness, improving coin and bar demand, strong gold leadership, continuing central bank accumulation, and now a new supply chain complication touching copper and chemicals at a very delicate moment. So yes, this is big, not because I think the whole system breaks tomorrow, not because I think every wild target making the rounds is suddenly conservative. It's big because another stress point has appeared in a market that was already easier to disturb than most people understood. And that is exactly how repricing stories build. Watch copper margins, watch chemical flows, watch investment demand, watch whether London liquidity keeps improving or starts tightening again, watch gold around macro fear, watch whether ordinary people wake back up to hard assets, and above all, watch your own emotions, because silver loves making people chase at the top and quit at the bottom. So let me ask you this. Do you think silver's next major move comes from industrial demand, monetary fear, or a surprise almost nobody is pricing in yet? And second, are you more interested in physical silver right now, or are you waiting for the paper market to confirm the story first? Either way, stay sharp. This market does not reward laziness. It rewards patience, attention, and the ability to tell the difference between hype and a genuine shift under the surface. For educational purposes only, of course. I'm sharing how I see the setup, not telling you what to buy or what to do with your money. Do your own homework, protect your downside, and make decisions you can still live with when this market gets loud.